Hi guys, Stanley here. I'm the co-founder of valueinvestasia.com, an investment portal where we give you investment news and also in-depth analysis of listed company every single week. So if you're new to the channel, remember to hit that subscribe button so you'll not miss out on any of our new videos. In our last video, we talked about how to create a diversified portfolio simply and also cost effectively. You can basically create a regular saving plan with FSM1 with just $50 a month. If you missed out on that video, remember to check it out right here. And today, we want to do something even better than just creating a diversified passive portfolio. Because some of us might want to do better than just having a passive ETF. After all, the one sure thing about investing passively is that we can always be sure that we will be underperforming the market. This is because most passive ETF tracks the market and we tend to have to pay a small fee to invest in them. Therefore, this means that by investing only through passive ETF, we will always be underperforming the market ever so slightly. Well, there is nothing wrong with generating a market average return. But what if for some of us, we want to do better than average? However, the general assumption is that to have a better return, we have to put in a lot more extra effort and also take a higher risk. For example, Warren Buffett becomes the world's greatest investor because he's so single-mindedly focused on investing at the expense of everything else in his life. You might not be ready to commit your life's work and time to find the next best stock to invest in. Yet, there are still some simple tips that we can use to increase our chances of beating the market easily. But first, I'd like to highlight that this video is also sponsored by FSM1, which is a division of iFast Corporation, a listed company in Singapore with a market capitalization of around $1.2 billion. And as a financial institution, FSM1 has been a key innovator in the brokerage space by being one of the first company to push for low-cost platform in Singapore. Now, with its intuitive software, you can invest across multiple asset classes like bonds, funds, ETF, stocks, and even insurance, all in one platform. More importantly, FSM1 pricing is extremely competitive and transparent, with a flat commission rate for Singapore stocks at just $8.8 per trade. For all the other information about their commissions, you can check out on their pricing page. Now, with their regular saving plan program, you can also create a fully diversified portfolio with ETF at just around $50 per month. Plus, FSM1 will not be charging any processing fee for its ETF regular saving plan, making it a very cost-effective way for all of you to start your investment journey. Anyway, you can find out more about FSM1 and its platform from the link from our show notes below. And although FSM1 is the sponsor of our video, I would like to highlight that the opinions and view shared here today is entirely my own. Now, here is how we can try to beat the market the easy way. I call this strategy the ETF Plus strategy. So instead of researching hundreds of stocks to find just the 2 or 3 dozen of them to create a diversified portfolio, we can utilize the benefit of ETF and then add on a few stocks that we are very optimistic about in the long term. After all, ETFs are a great way to start a diversified portfolio, allowing you to gain exposure to multiple companies without requiring a large sum of capital. ETFs also have a relatively low annual expense rate. For example, the Vanguard S&P 500 ETF, which Warren Buffett highly recommends, have only an expense ratio of just 0.04% a year. This means that if you invest $1,000 into this ETF, you will only be charged about 40 cents a year for maintaining it. On top of that, we can buy and sell ETF directly from our brokerage like FSM1, making it a seamless and easy endeavor. So once we have a portfolio that is made up mainly of ETF, we can then allocate a portion of it into picking up special stocks that we think can outperform the market. And those stocks could potentially give us the additional upside to outperform the market. For example, you can set about 80% of your entire capital to invest in ETF, while the remaining 20% capital to pick certain stocks that you like. But before we all run out to try out this strategy, there is one quality that we all need as an investor to win in the game of investing. And that quality is more important than just picking the right stock. To To win in the game of investing, the first thing that we need is to stay in the game. So the most important thing that we need is actually patience. Over the past 16 years, I saw many investors who got excited about investing during a bull market. Unfortunately, more often than not, the interest will fade as the market falls, especially when they suffer their first major losses. Then they might declare that investing is not for them and give up. The market might go through the usual cycle again, and when the next bull market come along, I can see these investors coming back all excited about the market again. My observation on why this investor might not be able to stay the course is mainly because of their investment time frame. They thought that they could make quick money from the stock market, yet the market has proven again and again that it will only reward those who are patient enough to have a longer time horizon. So if our only reason to invest is to win for short-term money, then most of the time it might end badly for us. This is because making short-term money in the stock market is mainly due to luck. But the longer we stay invested in the market, the higher our chance of growing our wealth sustainably. Once we have a long-term mindset, we can then form criteria on what kind of stocks do we want to invest in. And having a clear idea on what kind of stocks we want to invest in is very important, because without it, we might be merely just running around looking for a quick stock tip. And if we are basing our investment decision on the opinion of others, it will be very difficult to be successful in the long run. This is because the market is very dynamic and we have no access to how the other people will be thinking all the time. So when the market falls unexpectedly, we would not know how to react to it if we do not have a proper understanding of the stock that we invested in the first place. Unfortunately, the best way to form this criteria that suits you is to experiment. So you might have to try out different styles of investing in the beginning, learning both the advantage and disadvantages of this method, and then find one that suits you the best. I can give you an example in my personal case. I started out as an investor who is very obsessed with finding low value stocks. I only search and invest in stocks trading at maybe 8 times their earnings. I will scan through the 52-week low table every day on the newspaper just to find the cheapest stock I can find. And I did that for the first 6 years of my investment journey. And from this rather long experiment, I found that this method of investing is not sustainable for me. For one, most of the stock that are trading so cheaply tends to have some issue. So it might take me a long time to research this company to find out what is exactly wrong with them. Then I might need to come up with an opinion on how serious that issue might be and what is the reasonable valuation I should give each of them. And if I decided to invest in one, I would have to constantly monitor their share price, and as it reached close to my target price, I must remember to sell them off and restart the whole process again, finding the next stock. So instead of letting my money work for me, which is the ideal of investing, I'm just trading more of my time to find and make more money. Therefore, I realized that I need a better strategy if I want to make investing more sustainable for me. So over time, I formed my current investing philosophy, surrounding just a few simple ideas. I want to invest in good businesses with a great long-term prospect. It means that I want to find a company that is growing in an industry that can still continue for the next few decades. I want to make sure that the company is doing well in their sector, and also they must have a strong and trustworthy brand. This might give them a strong pricing power in the market. And last but not least, I would like management that are well loved and respected by their stakeholders. So I'll give you an example. When I look at a company like Microsoft, this is one with great brand. It also has services and products that are essential to both the corporate world and to consumers. On top of that, they have a history of strong and growing profitability and a good cash flow and strong balance sheet. So with such an approach in finding the right investment, I will be able to research on one company, invest and hold them for years to come. This reduces the turnover in my stocks and reduces the workload and time I need to maintain and monitor my portfolio. Your criteria on choosing a stock might be different from mine, But do take some time to think about what do you want from your investment and what kind of company you are most comfortable to invest for the long term. And once you have a clearer picture on the type of stock that you want to invest in, you can then add a few of those into your portfolio together with your ETF investment. In this way, you will have the market return coming from the ETF and also increase your chances to outperform the market with your individually selected stock. And that is how you can beat the market quickly and easily. And you can do all that through FSN1. Remember to visit their link through our show notes and just click on open an account to get started. I hope you find this video useful. As always, my name is Stanley. Till we meet again, invest safely.